All right, how much do Roth IRAs make? Not enough, right? I know. Hey, I'm Kurt from MartinMoney.com. Right out of the gate, I can tell you on average, Roth IRAs make around 7%, not adjusted for inflation. But no two Roth IRAs are identical. They're all different. And it all depends on what your goals are. It depends on things like your age, how far you are from retirement, how far you are from actually withdrawing the funds that are in a Roth IRA. So let's unpack this a little more and talk about what goes into what is actually returned into a Roth IRA account. All right, to start with, Roth IRAs, traditional IRAs, 401ks, 457s, 403bs, these accounts don't actually make any money. They just hold assets that produce a return. Think of them like buckets. You fill the bucket with stocks, bonds, mutual funds, whatever investments you want to put into it, and those are the assets that actually make money. The bucket itself is like a container for tax treatment, and there's three different types. The first would be traditional or pre-tax or tax-deferred is three ways I've frequently heard those described. That's when you make a contribution, when it goes into the bucket, if you will, you get a tax deduction for that. You don't pay any income tax starting out, but when you make a withdrawal in retirement, all the money you pull out of it, all withdrawals are taxed like income. Second type is Roth or after-tax contribution. Those you pay tax before it goes into the account. The growth in earnings, though, completely tax-free when you withdraw those later in life. And finally, you got taxable, which is like, basically money that you've got that's already been taxed. You put it in a brokerage account, say like a Charles Schwab or Vanguard, something like that. And the earnings on that are subject to capital gains whenever they're realized, or any dividend income is taxed whenever it's realized, and you pay that as you go. So both going in and coming out, there's a tax situation or tax implication for a fully taxable account. All right, now we already said that the actual bucket or container or the tax type isn't what makes you money. So the Roth IRA doesn't make you money, it's the assets. So what are the assets? Well, generally speaking, the return or the rate of return that you get in an account like that, the assets, is dependent upon the amount of risk you take. So you think about it like stocks generally return higher returns, or produce more income or produce more earnings, if you will, than say bonds typically. And that's because stocks are riskier. Bonds are a debt instrument. There's a guaranteed rate of return, assuming the bond issuer doesn't go into default. Stocks, on the other hand, just watch the ticker up and down every day. There's a lot of risk with stocks, and the rate of return is generally higher for riskier things because you're not going, say you have two things that they have a stock and a bond. This is an example. Let's say you have a stock and a bond that produce an equal rate of return. The bond is less risky than the stock. Why would you take more risk to purchase the stock if the return is the same? And that's why bonds typically are lower returns, and stocks have higher returns because stocks are more volatile than bonds. And that's just market forces. People gravitate to whatever level of risk and return accommodates their needs. So on the low end of the risk spectrum, you've got things like standard savings accounts. Treasuries are pretty low risk because they're backed by the government. Kind of mid-tier, you've got money markets and bonds from corporations, municipal bonds, things like that. They're a little more risky, but they're still less risky than stocks. Stocks are the riskiest, the riskiest debt instrument, stocks are typically the riskier equity instrument that you would purchase in a Roth IRA or 401k or something like that, because they're more volatile. And now when we're describing in a portfolio how many stocks you have or what percentage of stocks you have versus bonds, we call that asset allocation, and it's usually given in a ratio. 60-40 is the most common type. That means you would have 60-40 or 60% stocks, 40% bonds. There's also 70-30, 80-20. There's really no standard rule for this. Most people probably fall in that 60-40, 70-30 range. And those portfolios generally produce between a 7 to 8% non-inflation adjusted return over time. So, and that's another thing you need to remember too. Your time horizon kind of impacts the level of risk. So stocks are risky on a day-to-day basis. Like today, Microsoft is actually up like 3%. I noticed this morning. I don't know what they did, but their stock jumped way up. Well, tomorrow it could fall just as quickly. And that's day-to-day ownership of stocks. But over time, Microsoft is a pretty good stock to own, right? With that said, don't go buying stocks, individual stocks. You can buy baskets of stocks and spread your risk out. And mutual funds and ETFs, that's a good way to do that. But that time component actually dampens the risk. So if you have a longer horizon until you actually withdraw funds from an account like an IRA or 401k, something like that, the more time you've got, the more risk you can afford to take. Because odds are, in the long run, stocks are going to break great returns, right? For example, the S&P 500, which is a basket of stocks, has produced 10.67% over its lifetime. So I think it started in the 50s. That's over 70 years of recorded gains, but in a given year it could fall a lot. So generally speaking, the younger you are, the further you are from retirement, the riskier portfolio you're going to have, and the closer you get, the less risk you're going to take. So that asset allocation is going to go from like maybe 100 to 0, or 90-10, 80-20, down to 60-40, 50-50, something like that. Hey, if you haven't already, please click that like button and subscribe button below. That helps our channel kind of grow, helps people learn about us, and helps us teach folks about finance. Okay, asset allocation is how much you make. Tax diversity is how much you keep. We talked about the buckets and the different types. You got pre-tax or traditional, and then you have after-tax and Roth, and then fully taxable. How you use those buckets goes a long way into limiting your tax impact when you make. For example, in a case versus in Roth versus traditional, this is a question people ask a lot: which one should they contribute to? Generally speaking, if you're at a lower income tax rate, Roth is going to be better, and if you're in a higher tax bracket, traditional IRAs are going to be better. That's because you want to pay tax at a low rate. That's the Roth. If you're at a low income level, and then you want to avoid or delay paying tax if you're at a high income level. Now that tax diversity kind of gives you an arbitrage opportunity, because you may be in different tax brackets when you make a contribution versus when you make a withdrawal, but it also gives you a lot of control in retirement. Let's say you're not working anymore and you're in a space, let's say you're 65, you've just retired, and you got about 10 years until you turn 75, and any traditional accounts are going to have required minimum distributions. That's where the government forces you to remove money from the account and realize income on what's in there. With that 10 years, you'll be pulling income from traditional Roth or taxable accounts. And the way you do that will impact how you pay taxes. So if you pull everything out of a traditional account, it's fully taxable. If you pull everything out of a Roth, there's no tax. If you do some combination, then you can kind of temper how much you pay in tax every year. And if you're smart, you'll do some conversions and move some of the traditional money to Roth before required minimum distributions start when you're 75, and you'll do it right up to the top of whatever bracket you want to improve your tax efficiency. Just to kind of wrap up, Roths don't make money, 401ks don't make money, it's the assets within them. The assets you buy are going to determine how much you get in terms of a return every year and over time, and then where you put those assets, either in a Roth, traditional, or taxable account, is going to determine the tax efficiency of those. So different things at play, but if you're just asking the question, how much does a Roth make in a year? Generally it's about 7%. We way overcomplicated that with this response, but hopefully it was helpful to you. We got a lot more information on martinmoney.com. If you got a second, go over there, visit it. We got some links down in the description below that you can check out, and we always appreciate you guys watching our videos. Thanks a lot.